So this is a quick run through on the wheel strategy we talked about. All right, just to make some cash flow on both sides. So if you want to purchase a stock for a lower amount and you know that it's on a downtrend or it's on a pullback and you anticipate that it's going to drop down to a support level, you can get a contract um, at the strike price that's close to the support level and get a premium for that contract. And then if it reaches your strike price by the expiration date, you'll get exercised. You'll purchase those 100 shares. And then the other side of the wheel strategy is on the other side of it, you'll have those 100 shares. And then you can turn around and write cover calls on the shares that you own and make cash flow off of what you hold. All right. So just from top to bottom, we can start out with some of the screeners that I send every day to the screeners channel. All right, so you can look at this list and it'll tell you, high premium cover calls. I had a high premium naked puts list on here, but specifically for this wheel strategy, you want to see both sides of it. So um, we're gonna go with Riot. All right, Riot is usually always on both of those lists. So Riot is here. You see this one. All right, $40 and 89 cents was the current price, and the strike was $60. Um, the bid price was like 153 and 143. It went all the way up to 150. All right, so potential return on your investment for this, like a 52% return on your investment if you did this. But notice that the strike price is higher than the share price because it's premium cover calls. So you're basically looking forward to owning those shares, and then you're looking to see how much you could possibly get off a premium if you wrote a cover call with this strike price. So you basically agreeing to sell your shares for $60, and that, depending on where you purchase them at, that could be something like a $20 spread right there between the current price and the strike price with an expiration date of May 21. All right, you'll be able to collect anywhere from 143 to $150 per 100 shares or per contract that you write. All right, so that's the other side of the wheel strategy. So the first side of it, what you want to do is you want to find support and resistance like we always do, and you want to see where the trend is at. So let's say for instance, Riot Blockchain, you see that you got support right here. All right, on the downside, you got support right here. All right, and then you got resistance up top. Okay, so you got some resistance right there. All right, and we just trying to find the pattern just to see, how we measure this thing. So you see that it's inside of a little pattern right here. All right, the triangle. It looked like it's gonna break out to the upside, but we don't know when that's gonna happen. As of right now, it just bounced off of support and it's going up. So no telling how far it's gonna go up. But as of right now, it is in the downtrend. We're on the daily chart right now, so it's still a buyer's market, but it's been consolidating since what's that? Was that February 17th? So ever since then, it's been consolidating down into this range or retracing down into this range. Um, so just to give you the scenario, right? This was Friday. This candle right here was Friday. Let's say, for instance, you was looking at contracts to purchase Riot Blockchain, and your expiration date was April 23rd. All right, so this is April 23rd right here. You would have had your strike price down here at the support level around $34, $33. All right, obviously you're not going to be able to see the exact amount on here because we got new expiration dates. But let's say, for instance, you had something like that, and we're using this as an example. Your strike price would have been anywhere between $34 to $33. Um, 34, 33. All right. Make sure you got it on sell put. All right. So all the way down, 33, 33, $34. All right, you would have got anywhere between $23 to $30 on premium for this. You would have had to have at least $3,400 in your Robinhood account. All right, so you need to have $3,400 in your Robinhood account as collateral in order for you to execute this strategy. If you don't have this amount, you're not gonna be able to do this. You feel what I'm saying? Or unless you got margin enabled on your account or something like that, you need to have this money as collateral because if you get exercised, it's gonna automatically deduct that amount and give you those shares. If the strike price and the share price are close when you're at expiration. All right, so let's just say in this scenario that you think the price is going to come back down to support. All right, let's just say you think the price is going to come back to support, or maybe you got working with a new support level and you think price is going to like come back down to this range right here, like 39. All right, and the expiration date is April 30th. So you think it's going to come down to 39, right? So what you're doing is you getting $143 up front immediately, all right, and they're gonna hold 3,900 off your account, all right, and then if the share price comes down and reaches your strike or goes lower, you automatically get exercised at the expiration date, all right. So that's the first side of it. So you basically what you're doing is you buying the stocks at a cheaper price than where it's at right now, and you're getting paid to do it. So you're getting paid to take the risk. All right. The person on the other side who owns those 100 shares is willing to sell them to you at that share price or at that strike price, and they're willing to pay you a premium to agree to do it ahead of time. So you're taking on the risk of the stock dropping all the way down to $20. If it drops all the way down to $20, you still have to get these shares for 3,900. That's the risk you're taking on. So you have to be smart about how you gauge this, and the best way to do it is to find support and resistance. Mainly support, because if you find a good support range, basically what you're saying is you don't think the price is going to go below this area. You don't think it's going to go below this zone. So anywhere upwards of this is a safe bet for you. Now it just depends on how much premium you want to collect. All right, so you could play with this. Now, if you trust your chart patterns like you should, then you'll know that, all right, it's only going to do one or two things. It's either going to break out to the upside or it's going to break out to the downside. One or the other. If it breaks out to the downside, I'm going to lose money because my strike price is obviously going to be higher than where it's going to drop to. So I could be at a position where I'm losing money automatically or before I even get a chance to get the other side of the wheel strategy. Or it could break out of this to the upside and you end up buying these shares for way cheaper than where they're supposed to be. Now, the year's forecast for Riot is $64. Right now it's at 40. So, it could drop before it goes up, but what they're saying is they believe that the fair value by this year should be around $64. So finding support. So my support level is anywhere between $34 and $33. All right. And I don't think the price is going to drop below this. It might consolidate within this range for a while. Maybe it'll bounce off of the 200 moving average if it moves up here. But eventually it's going to break out to the upside and work its way up until it hits its target for the year. All right. So with this scenario, anywhere within this range right here should be safe for you. All the way down to $33. I wouldn't go anywhere lower than that if you actually want to get the shares. The other side of this is this. Let's say, for instance, you don't even really care too much about taking the shares. You just want to make the cash flow. Well, you have to gauge how much return you want to get. If you have to put $3,900 up for collateral, and in exchange, all you're getting is $143. To me, that's not a good risk to reward, and it's not a good ROI for the money. If you give me $3,900 in a week, I'm gonna pull more than $143 out of the market with that. Some people, think think that that's a good return and it's a safe bet. Some people are like, well, I don't really necessarily care about the return right now. I'm really just trying to get the shares for cheaper and collect premium while I wait. And because I'm anticipating doing something on the other side, like a covered call, or I just want to own the shares just because I want to own the shares. So Warren Buffett, he has a whole lot of cash available. He's not going to purchase anything at market value. He's going to take the cash that he has, use that as collateral, all right, and then agree to purchase the shares at a lower price and wait for the dip. As the price drops down to his strike price, he collects hundreds of thousands and millions of dollars in premium while he waits for the share price to drop to his strike. And then he gets exercised and he takes those shares, all right, and becomes an owner of those shares, but he got paid while he waited. You feel what I'm saying? So you putting that money to work instead of just having it sitting in his account, waiting for the strike price or waiting for the share price to drop to a reasonable value for him to go ahead and buy it. He already waiting on it. He already in position. So you got the ability to do the same thing. So now you got that. Now you got exercise. All right. We get to April 30th or whatever. You got exercise. You got the 100 shares. You paid $3,900 for them. You got $143 up front. Now that you own the shares now, you go back to the chart and you say, okay, now I want to write covered calls. So I bought my shares at $39 per share, but I don't want to let them go at 39. I want to let them go at a higher price, and I want to let them go at a higher price and get paid up front for it as well. So 2 ways you could do this. One, you could go to the flip side, sell call. All right. Now you working up in this range right here. So what you're doing is if you want to keep the shares, you want to go as high as possible, because if you want to keep the shares, you want to put your strike price at a range to where you don't think the price is going to reach by April 30th. How do you do this? Well, same way you do the first side of it, finding support. Now you're selling, so now you find a resistance. Where's your resistance level at? Well, you got resistance here with the moving average. You got resistance here with the moving average. You got resistance here with the trend line. You also got a price target for the year, and you also have your weekly pivots because you're doing weekly contracts. So with the weekly pivots, they're going to tell you what the resistance levels are for that. All right. So you could do one or two things. One, you could say, okay, you know what? If this is an uptrend, we know that it's a high possibility that the share price is going to actually reach R1 by the end of the week. So I don't want to go with R1. Maybe I want to go with R2. You feel what I'm saying? So if I go with R2, then that's like $49, $49.70 something. Where's what strike price we got? We got 49, we got 50. So if I wrote a cover call, all right, on the other side of the wheel strategy, I got $49 strike price. I'm gonna get paid about $33 for this. All right. Anything higher than that, I'm gonna get paid $25 for this. Maybe you want to make more money off of your shares. You feel me? Maybe you want to make more money. Well, if you want to make more money, you're gonna take on more risk, which means you're gonna have to bring your strike price down a little bit closer. Now, you have to be able to gauge that depending on what your resistance level is. Let's say, for instance, you say, you know what, I want to risk it and put my price target at like 46, and my strike price at like 46. You put your strike price at 46, you make about $68 on that. Maybe you're comfortable with that. All right. Let's say, for instance, you pick this as your strike price, and then by the time Thursday comes, the share price start going up, and it start getting closer and closer to your strike price. But you don't want to let the shares go. How do you manage that? Well, all you got to do is close the contract. So how do we close contracts? You're writing a call. So you're selling a call. So you have to buy it back. So in order for you to close the contract, if you don't want to get exercised and actually get to a position where you're selling your shares, then you have to buy the contract back for however much it's going for. So normally you're going to end up spending less money than what you got paid in premium. All right, depending on how close it is and whatnot. But obviously, as the share price gets closer and closer to the strike, that contract is going to be more and more valuable. So you have to be able to gauge whether that risk or reward makes sense or not. All right. So that's that's in a nutshell how you do it. Now you see the pivots, you see support and resistance. All right, and you got all your chart patterns and everything like that. Only thing you really need to be worried about is the premiums and how much you trying to get paid on ROI. I give you the screeners to let you know what's available as far as the highest premium for each individual stock. All right, cover calls specifically is on here. All right. Now I don't have a regular naked put, but what I do have is I have dividend naked puts. So in this scenario, what we talking about is not only are we trying to make premium by writing a naked put on some shares that we might potentially get exercise on and own. You don't necessarily want to get exercise on stocks that you don't want to really own. I understand that there's a lot of stocks that pay you super high premium for these type of strategies, but they might not be the stocks that you really want to own in your portfolio. They might be too risky for you. So if you want to go with a valuable stock, then in my suggestion, I will go with something that pays dividends. Because if you get exercised on a naked put, you're actually getting shares of a company that's going to pay you cash flow. So now you're getting cash flow for owning the shares, and you could potentially get cash flow for writing cover calls as well. So you're hitting them twice. And you buying them at a cheaper price if you do it right. So you could get paid almost 3 times with this strategy if you use it with dividend paying stocks. So you got Viacom on here. All right, you got UPS on here, Qualcomm, a couple companies that we know. Avgo on here, ones that we recognize. All right, you can check these out and look and see like, okay, there's your potential return on here. Now, it ain't nothing too crazy because you know that the most valuable stocks, the ones that pay dividends and all that, they're not necessarily going to give you the high bid prices and the high premium that you might want. But you're getting more money in the long run because you're getting dividends and you're getting growth in the company and you're getting premium on both of the strategies. So for this particular company, the price is at $26 right now. Strike price $25 for a naked put. That's like almost $1. That's over $1 less than where it's at right now. You have to look at it on the chart and see what type of trend it's going with. All right, and then you got your premium. So you get paid $52. You know what I'm saying with this particular one. All right, that's not bad. You feel what I'm saying? That's a 2% return on your investment. That's pretty good for an investment. For one side of it. Now you get exercise and you take on 100 shares. Now you got to go and see, well, how much does this company actually pay in dividends? All right. This is a company that doesn't pay a high amount of dividends, but it's been something that's very, very I wouldn't call it popular, but all right. So Bill Gates actually liquidated a large amount of his stocks in his portfolio and loaded up on this company right here. All right, this company, I think this is a healthcare sector, if I'm not mistaken. And I think they actually had an earnings call this week, if I'm not mistaken. But this company right here, you know, the dividend ain't too impressive, but it is something. All right, it is something. They do pay, and you see they've been paying consistently. Okay, so what you want to do is you want to go and you want to find out exactly what type of position this thing is in on the chart and see if it even makes sense. All right, so you see it's pulling back. All right, you see it's at the top of a pullback, so it might be coming back down a little bit more. You might want to put your strike price somewhere here, like right here, or maybe even at the support of the moving averages. All right, collect premium on that side, get the shares, and then come back around and write the cover call up here at the resistance level for the next week. All right, for the next week after this gives you a new set of pivots, you want to take it up to the next level and do the resistance on that. So that's basically what you're doing. You're trying to find something that makes sense. Don't always focus on the ones that pay you high premium if you don't actually want those shares in your portfolio, because you might get exercised. All right. If you don't want to get exercised, now you have to be strategic about what strike price you choose. All right. So in this scenario, let's say for instance, I don't really want Riot blockchain. I just want the cash flow. Well, you got to gauge what makes sense. Expiration date April 30th for $3,000. To me, this ain't really a stock that I would like to play with because the premium that I'm getting, it don't even make no sense. There's a few other companies that usually pay a higher dividend. A higher premium. The most volatile stocks are the ones that pay you the highest premium. You feel me? Because they're the most risky. So you're gonna see the premiums go up on stocks that have a lot of volatility. All right, high volatility is what gets you the most premium when you're dealing with naked calls, naked puts, and covered calls. All right, so just keep that in mind. All right, but I'm giving you screeners so you can check those out and do it as risky as you want or as safe as you want. Whatever you want to do, it's up to you. Now I've done this with, for instance, I did this with Exxon, right? I can't remember exactly what price I bought Exxon at, but in this scenario, I bought Exxon because I saw it on a downtrend, and I knew that it was going to come to a support level. I found support, and I put my strike price at support. The price came all the way down to the support level. I got exercised. All right, I got exercised. I got my 100 shares, and then the next week, the trend turned around, and it was almost like I had a perfect entry because the price took off from that point moving forward. This was a few months ago, all right, probably like February when I did that. So I got paid premium up front. Then I got the shares, all right, and then I'm getting dividend payments because now I got the shares in my portfolio. I didn't turn around and write cover calls on that. I could have, but I didn't. Mainly because I wanted to keep those shares in my portfolio, but also because the premium ain't even really attractive enough for me to play with like that. Now, if I really wanted to sell them, I could sell them at a resistance level and then get paid premium up front. But for me, it was like I'm gonna get paid more on a dividend, and just wait and let it hold and let it build my portfolio while the value increases, rather than me sell it at a higher price to get a little bit of premium. I'm selling them at a higher price, but long term, you want to look at holding something like this. If you get a super good price on it, you might not want to let it go that easy. You feel what I'm saying? So you really just got to gauge what type of strategy you want to use with this. But the strategy is available. So again, I'm giving you the the screeners. All right, so the screeners is going to put you in position to where you can see both sides. All right, high premium covered calls. Usually when the premium is high on covered calls, it's usually pretty reasonable on the naked put side too. That's usually how I see it. And then dividend naked puts, the ones that if you get exercise, at least you're getting paid dividends. These are the ones that are valuable. This is the list that Warren Buffett would be looking at. You feel what I'm saying? If he was using screeners, he probably ain't using screeners, but if he was using screeners, this is the list that he'd probably be looking at. Like which one of these dividend paying stocks is paying good premium on, you know what I'm saying? So let me go ahead and put this 10 million to work and get paid while I wait for the stock price to drop. And when it drop, I'm gonna go ahead and get these shares, and then when it take back off, I'm looking like the man again. You feel me? I done got paid twice. All right, so that's how we do it. All right, if you got any more questions, let me know. All right, peace.